Foreclosure investing looks simple on the surface. A property falls behind on payments. It goes into default. The lender forces a sale. An investor steps in, buys below market value, and walks away with built-in equity. That is the story most people hear. What many first-time investors in the United States do not see are the legal gaps, title problems, hidden repair costs, occupant risks, and cash flow pressure that sit behind that discounted price. The discount exists for a reason. If you do not understand that reason, the deal can turn from opportunity into liability very quickly. Foreclosure investing in the U.S. usually happens through three channels: pre-foreclosure negotiations, public auctions on courthouse steps, and lender-owned properties listed after repossession. Each stage carries a different risk profile. Treating them the same is a costly mistake. At the auction level, most properties are sold as is. Investors often cannot enter the home before bidding. Interior condition is unknown. Plumbing leaks, mold growth, structural damage, or vandalism may only become visible after closing. In several U.S. states, once the gavel falls, deposits are non-refundable. Funds are due within a short window, sometimes 24 hours. That means capital must be ready and liquid. Another overlooked factor is lie-in priority. A foreclosure auction typically wipes out junior liens, but senior liens can survive. Property tax arrears often remain attached to the home. Municipal code violations may also follow the property, not the previous owner. If an investor fails to run a thorough title check before bidding, unpaid obligations can erase projected margins. Pre-foreclosure deals appear more flexible. An investor negotiates directly with the distressed owner. The numbers may look attractive because the seller wants relief from pressure. Yet this stage involves timing risk. If the lender proceeds faster than expected, the window to close can shrink. Title issues may surface late. Emotional stress on the homeowner can delay paperwork or derail agreements. Professional handling and documented timelines are essential. Lender-owned properties, often called REO properties, feel safer because they are listed on the open market. Access for inspection is usually allowed. Title is typically cleared before listing. Even here, hidden risks remain. Many banks price aggressively in competitive markets. Multiple offers push prices closer to retail levels. Repair budgets are often underestimated because visible damage is only part of the cost. Deferred maintenance may have accumulated over years. Repair risk is one of the most underestimated elements in foreclosure investing across the United States. Homes that sit vacant for extended periods deteriorate faster. HVAC systems may fail. Pipes can freeze in colder states. Roof leaks may spread into framing. Local contractors report that vacant homes frequently require higher rehabilitation budgets than owner-occupied properties of similar age. Property taxes, utilities, lawn maintenance, and security expenses continue whether the property generates income or not. Occupancy risk also deserves attention. In some foreclosure auctions, occupants remain inside the property. They may be former owners or tenants. Removing occupants legally requires formal eviction procedures governed by state law. Timelines vary by jurisdiction. Court backlogs in certain counties can extend the process for months. During that time, the investor cannot renovate or rent the property, yet holding costs continue. Market timing risk adds another layer. Many foreclosure investors assume immediate appreciation once renovation is complete. Real estate markets in the U.S. move in cycles. Local demand can soften due to employment shifts, migration patterns, or rising property taxes. If resale depends on peak pricing, small changes in buyer demand can reduce profits sharply. Financing structure matters as well. Some investors use short-term private funding or hard money loans to close quickly. These structures often include higher fees and shorter repayment windows. If renovation overruns or resale takes longer than planned, pressure increases. Forced resale under time constraints weakens negotiation power. Another hidden factor involves comparables. Distressed properties are often located in neighborhoods with mixed conditions. Comparable sales may include other distressed homes, which lowers appraised values. After renovation, achieving full retail pricing depends on surrounding property quality, school ratings, and buyer perception of the area. Discount entry price alone does not guarantee profitable exit. Operational discipline separates sustainable foreclosure investors from those who struggle. Detailed due diligence is standard practice among experienced professionals. This includes title searches, tax verification, lien checks, contractor walkthroughs when possible, and conservative repair estimates with contingency reserves. Many seasoned investors build a buffer of 10 to 15% above projected rehab costs to absorb surprises. Cash reserve planning is critical. Foreclosure projects often tie up capital longer than expected. Investors who rely on tight timelines expose themselves to liquidity strain. A single delayed project can block participation in other opportunities and reduce overall portfolio stability. Ethical considerations also affect long-term reputation. Foreclosure situations involve financially stressed households. Professional investors operate with transparency, documented agreements, and compliance with state regulations. Short-term gains achieved through aggressive tactics often lead to legal disputes and reputational damage. Foreclosure investing in the United States can generate value when managed with discipline, research, and structured risk control. The discount reflects complexity, uncertainty, and responsibility. Investors who treat it as a shortcut to quick equity usually encounter friction. Those who approach it as a structured acquisition process with legal, financial, and operational safeguards build more stable outcomes. Understanding these hidden risks is the foundation. Without that foundation, projected profit exists only on paper. With it, decisions become data-driven and controlled. Foreclosure investing becomes significantly safer when investors shift focus from price alone to process control. The discounted purchase price attracts attention, yet sustainable performance depends on structured evaluation before capital is committed. The first control layer is legal verification. Every foreclosure property in the United States exists inside a specific state framework. Judicial foreclosure states require court involvement. Non-judicial states follow trustee procedures. Timelines, redemption rights, and documentation standards vary. An investor operating in Texas faces a different legal sequence than one operating in Florida or Illinois. Reviewing state statutes and recent county-level procedures reduces surprises. Redemption periods represent a critical variable. In certain states, former owners retain the right to reclaim the property within a defined window after auction by paying outstanding obligations. While this does not occur in every transaction, investors must verify whether redemption rights apply before allocating renovation funds. Starting major improvements before redemption deadlines expire can expose capital to reversal risk. Title clarity requires structured investigation. Professional foreclosure investors routinely order preliminary title reports before auction when possible. They verify outstanding property taxes, municipal liens, HOA dues, and recorded judgments. County tax collector databases, recorder offices, and municipal code enforcement departments provide public records. Skipping this research phase transforms a calculated investment into speculation. Physical condition assessment requires discipline even when interior access is unavailable. Exterior inspection can reveal roof sagging, foundation cracks, window damage, water intrusion signs, and neighborhood condition. Reviewing prior listing photos from real estate databases may offer insight into earlier interior layout and condition. Speaking with neighbors sometimes uncovers how long the property has been vacant and whether utilities were shut off. Each data point reduces uncertainty. Rehabilitation budgeting should follow a structured worksheet rather than rough estimates. Line item costing for roofing, electrical, plumbing, HVAC, flooring, drywall, paint, and permits builds clarity. Permit costs vary significantly across U.S. municipalities. In some cities, unpermitted work discovered during resale can delay closing and increase expenses. Including inspection fees and contingency reserves strengthens projections. Holding cost calculation is often underestimated. Property taxes accrue daily. Insurance for vacant homes carries higher premiums. Utility activation fees, water bills during renovation, lawn maintenance, snow removal in northern states, and security systems add up. Investors who calculate only mortgage equivalent costs overlook these operational expenses. A detailed monthly holding cost projection aligned with realistic renovation timelines improves accuracy. Exit strategy alignment must occur before acquisition. Some foreclosure investors plan resale after renovation. Others convert to rental property. Each path carries different requirements. Retail resale depends on buyer financing standards, appraisal thresholds, and neighborhood comparables. Rental conversion depends on local rent levels, tenant demand, property management capability, and maintenance reserves. Selecting exit strategy after purchase introduces instability. Local rental market research should include vacancy rates, average days on market, median rent by bedroom count, and tenant income levels. U.S. Census data, local property management reports, and county housing statistics provide measurable information. Investors who rely on informal estimates often misjudge achievable rent. Tax implications also influence outcomes. Renovation expenses may affect cost basis. Capital gains treatment depends on holding period. Property tax reassessment can occur after transfer in certain jurisdictions. Consulting a qualified tax professional familiar with local regulations improves clarity and prevents compliance errors. Liquidity planning separates resilient investors from stressed operators. Even well-researched projects face delays. Contractor scheduling shifts. Material delivery slows. Weather impacts exterior work. Court timelines for occupant removal extend. Maintaining accessible cash reserves allows projects to continue without forced resale. Market participation structure matters as well. Some investors use pooled capital partnerships or private equity-style joint ventures to move quickly in competitive foreclosure environments. These arrangements require clear written agreements, defined profit distribution, and transparent accounting. If renovation overruns or resale takes longer than planned, pressure increases. Structured capital planning reduces that pressure and protects negotiation power. Risk distribution across multiple properties reduces exposure concentration. Placing all available capital into a single foreclosure project magnifies impact of unexpected complications. Portfolio diversification across neighborhoods or property types balances variability. Professional investors view each property as part of a system rather than an isolated transaction. Contractor selection significantly affects profitability. Lowest bid pricing often excludes scope details. Written contracts specifying materials, timelines, payment schedules, and inspection milestones create accountability. Staged payments tied to completed work protect capital. Unstructured cash advances increase fraud risk and delay completion. Neighborhood trajectory analysis adds context beyond property condition. Reviewing recent sales volume, building permit activity, school district ratings, and employment centers within commuting distance helps measure demand strength. Public Planning Department reports sometimes outline infrastructure improvements or zoning changes that influence future desirability. This information supports pricing strategy and holding horizon planning. Emotional discipline plays a measurable role. Competitive bidding environments at foreclosure auctions can create pressure. Establishing a maximum allowable offer before auction day and adhering to it prevents overpayment. Professional investors calculate allowable purchase price by subtracting repair costs, holding costs, transaction fees, and target profit margin from conservative after-repair value estimates. This formula anchors decisions to numbers rather than momentum. Transaction costs require full accounting. Closing fees, title insurance, transfer taxes, recording fees, agent commissions on resale, and staging expenses reduce net profit. Omitting these items from early projections inflates perceived margins. Time management influences return efficiency. A project generating a $20,000 profit over 4 months performs differently than the same profit over 12 months. Calculating annualized return clarifies performance comparison across deals. Investors tracking timeline metrics improve capital rotation. Regulatory compliance deserves structured attention. Some municipalities require vacant property registration. Others impose daily fines for uncut grass or unsecured structures. Understanding local ordinances prevents penalty accumulation. Professional property management software can track deadlines and documentation. Data tracking builds long-term advantage. Recording actual repair costs versus projected costs, timeline deviations, and resale performance generates a personal database. Over time, patterns emerge. Certain property ages may require higher electrical upgrades. Specific neighborhoods may show longer resale periods. Data replaces guesswork. Partnership structures should define capital contribution, profit distribution, decision authority, and dispute resolution in written agreements. Foreclosure investing often involves joint ventures due to capital intensity. Clear documentation protects relationships and aligns expectations. Market cycle awareness strengthens stability. During expansion phases, competition increases and margins tighten. During contraction phases, inventory rises, yet resale velocity slows. Monitoring local employment statistics, migration trends, and housing supply levels informs acquisition pacing. Adjusting volume rather than chasing every opportunity preserves capital. Risk management extends beyond the property itself. Personal financial structure matters. Investors who rely entirely on projected flip profits to meet personal expenses face stress under delay. Separating personal financial stability from project timelines enhances decision quality. Professional foreclosure investing in the United States functions as a disciplined acquisition model built on legal research, cost control, liquidity planning, and ethical conduct. The discount attached to distressed property compensates for uncertainty, administrative effort, and capital lock-in. When those elements are measured and managed, risk becomes structured rather than hidden. Long-term success rarely comes from a single transaction. It comes from consistent process execution. Each deal contributes data, experience, and refined evaluation criteria. Investors who document, review, and adjust build resilience across changing market conditions. Foreclosure properties will continue to appear in every economic cycle. Some emerge from job loss, medical hardship, or market shifts. Behind every listing sits complexity. Approaching that complexity with structured due diligence transforms foreclosure investing from speculative pursuit into controlled asset acquisition. Clarity, preparation, and disciplined execution determine outcome. Price alone never tells the full story.